The number hit the Bloomberg terminal like a flashbang. $57.8 billion gone overnight. Canada, once the U.S.'s quiet, reliable financial partner, had just unloaded nearly 15% of its Treasury holdings in a single month. Traders didn't blink. They panicked. At the center of it, Trump's tariff package, a sweeping unilateral move slapping up to 30% tariffs on Chinese goods and imposing a 10% floor on all imports outside North America. But instead of isolating Beijing, Washington triggered a silent revolt. Not from adversaries, but allies. The most aggressive response didn't come from China. It came from Canada, which had just been targeted with renewed steel and timber tariffs weeks earlier. According to U.S. Treasury Department data released June 18th, Canada's holdings of U.S. debt plunged from $426.2 billion to $368.04 billion in April, a move that dropped it from 5th to 7th place among foreign creditors. This isn't a currency war. It's something quieter, colder, a financial disengagement. China, long accused of weaponizing its Treasury holdings, only reduced its U.S. debt by $8.2 billion, its lowest monthly cut this year. Yet the significance lies in consistency. April marked China's second consecutive month of selling, bringing its total to $757.2 billion, the lowest since 2009 per Treasury International Capital data. Unlike Canada's sharp dive, China's moves are methodical. In April alone, it added 70,000 troy ounces of gold, raising its official reserves to 2,292 tons, now 6.7% of its $3.2 trillion in foreign reserves, up from just 4% 2 years ago. This pivot is not merely financial, it's strategic. Irony sharpens here. Despite face value purchases totaling $9.2 billion, Canada's highest since 2023, the mark-to-market losses from April's yield spike wiped out those gains sevenfold. Canada didn't just sell, it lost value on what it kept. As Treasury yields spiked, marking the steepest rise since 2001, bond prices fell, and central banks paid the price. While headlines fixated on China, 6 U.S. allies were trimming in tandem: France, Germany, Switzerland, Norway, Luxembourg, and South Korea. Together, they cut U.S. debt holdings by $14.2 billion in April. This wasn't mass panic, it was reallocation. Eurozone bond yields had surged thanks to Europe's fiscal stimulus and a stronger euro, drawing global capital inward. According to Barclays data, central banks now account for 20% of Eurozone syndicated bond purchases, up from just 8% in 2021. France and Germany, through joint EU bond initiatives, have made euro-denominated debt liquid enough to compete head-to-head with U.S. Treasuries. That's new. The contradiction is stark. The U.S. introduced tariffs expecting pushback from China, but it's its allies who are financially repositioning first. South Korea's National Pension Service shifted billions toward euro and emerging market bonds, citing better long-term parity in yields. Norway's $1.6 trillion sovereign wealth fund did the same, adjusting bond exposure without triggering headlines, just portfolio memos. Even Switzerland, long the poster child of U.S. debt stability, reduced Treasury exposure as part of a regulatory-driven rebalance. Not out of fear, but because liquidity elsewhere had improved. Let's freeze this frame. Because if you assume these moves were political, you might be missing the bigger risk. They weren't personal, they were procedural. What if the mass sell-off wasn't protest, but preparation? By May, the signs had compounded. The euro appreciated 12% against the dollar in the first half of 2025, making U.S. debt more expensive for foreign holders in FX-adjusted terms. Meanwhile, Eurobond issuance surged, giving global investors alternatives with rising yields and lower perceived political risk. In March, Canada issued a $3.5 billion 5-year global bond, which drew $14 billion in orders. Quadruple demand. Proceeds weren't used domestically. They were earmarked for higher quality euro and Canadian instruments. That decision came weeks before the Treasury dump. There's a pattern here, yet paradox emerges again. Canadian pension funds and insurers increased their U.S. Treasury purchases in April. Statistics Canada confirms net inflows, despite Ottawa's sell-off. Why? Because the new bonds were attractive, offering the highest real yields in over a decade. Traders are betting short-term pain delivers long-term gain, Canada's government is reducing exposure to macro risk. Its private sector is chasing short-term returns. Much of what's now threatening the dollar's dominance was actually built with American encouragement. The European Union's bond market liquidity? Well, that was backed by United States institutional investors. China's offshore yuan system, developed in part with the help of Western banks. Even gold's renaissance was fueled by Fed-driven inflation and, political volatility. The United States wrote the playbook that's now being used to unwind its own financial leverage. Emerging economies are also entering the fray. India, Brazil, and South Africa, previously heavy Treasury buyers, have scaled back purchases, now favoring onshore instruments and multilateral reserves. Brazil's central bank actually raised its gold holdings to a 50-year high. India's Reserve Bank is increasing rupee-denominated bond liquidity to reduce reliance on United States debt markets. It's not a boycott, it's a branching out. Despite this seismic repositioning, total foreign holdings of United States Treasuries still stood at about $9.13 trillion in April, just $36.1 billion below the month prior. This is the paradox. The system is unwinding slowly, not suddenly. The exodus is deliberate, surgical, and honestly, pretty quiet. There's no run on the dollar, but there is a steady erosion of its centrality. The White House hasn't acknowledged the Treasury sell-off directly. Instead, Trump has emphasized strong job growth and manufacturing gains under the tariff regime. But, analysts at ING and Citi have flagged the April bond data as a signal of growing reserve polarization, where financial institutions are forced to choose between yield and political exposure. The timing of the Canadian cut, coinciding with new lumber tariffs and cross-border energy friction, suggests economic messaging cloaked in portfolio decisions. Still, attributing direct political motive remains speculative without official confirmation. It's tempting to read this as retaliation, but what the data confirms is structural repositioning. Yield shifts, currency differentials, regulatory rules, and FX hedging costs now make treasuries less automatic as a reserve pick. Even Japan, the largest U.S. debt holder, increased holdings by $3.7 billion in April. But as a counterpoint, not a trendsetter. The final contradiction may be this. The U.S. Treasury market is so dominant, so liquid, so vast, that it gave the world a safe place to sell it. Liquidity, once America's strategic moat, is now the exit ramp. And yet, no single actor can collapse it. Canada's $57.8 billion exit. That's less than 0.7% of total foreign holdings. China's cut? Barely 0.1%. What's shifting is not the mountain, it's the weather around it. Canada didn't burn the bridge, it built another route. China didn't sell to shock, it bought gold to insulate. The EU didn't exit, it matured into a co-equal system. The question isn't whether the US dollar will collapse, it's whether the world still needs one reserve anchor at all. But, as capital disperses, pressure converges. On Washington. Behind the scenes, the Federal Reserve is now forced to walk a thinner line. In April, Treasury yields surged across the curve. The 10-year note briefly touched 4.92%, while the 30-year hit its highest point since 2011, according to data from the Federal Reserve Bank of St. Louis. This sudden spike raised borrowing costs not only for the government, but for every mortgage, auto loan, and corporate bond in the system. In theory, tariffs were designed to shrink trade deficits, but in practice, they've inflated the government's cost of borrowing. The irony grows deeper. As Trump champions so-called economic patriotism, the tariffs are expanding, not shrinking, the budget shortfall. According to the Congressional Budget Office, the U.S. deficit for fiscal year 2025 is projected at $1.9 trillion. Up from $1.6 trillion the year before. Interest payments alone could hit $892 billion, making it the fastest growing category in federal spending. When Canada sold $57.8 billion in treasuries, it didn't just create market noise. It repriced U.S. debt itself, forcing higher yields to attract replacement buyers. But higher yields mean higher costs for the very nation those buyers are exiting. In effect, foreign governments are now setting the price of U.S. fiscal choices. And still, the dollar hasn't collapsed. That fact alone invites complacency. But currencies die slow deaths. They don't scream, they fade. The last time a global reserve system unraveled, it happened gradually, not explosively. The British pound, which once underpinned global finance, remained in use for nearly 25 years after World War I, even as its empire crumbled. Sterling's decline was managed, not declared. Central banks hedged, shifted, and eventually abandoned. The same signs now shadow the dollar. According to the IMF's COFR data, the dollar's share of global reserves has fallen from 71% in 1999 to just 58.4% in 2024. The euro holds 20.1%, and gold, previously seen as a relic, now comprises 15% of total central bank purchases for the year, according to World Gold Council data. One reason is control. Gold isn't subject to sanctions. Euros aren't dictated by Capitol Hill. Even China's renminbi, though less liquid, is now used in trade settlements between BRICS nations, replacing the dollar in bilateral transactions with Russia, Brazil, and Iran, according to SWIFT data from May 2025. Reserve decisions are no longer just about return. They're about insulation. Yet Washington's strategy appears unchanged. Trump's tariffs have returned the U.S. to a 1980s-style trade brinkmanship. But the financial world no longer runs on Cold War rules. In 2025, capital is mobile, portfolios are programmable, and reserve decisions are executed in milliseconds. This agility is what the U.S. may be underestimating. Meanwhile, Europe is pushing ahead with fiscal unity. The Next Generation EU fund, which started as a post-COVID initiative, has now expanded into a permanent fiscal backstop. According to the European Commission, the bloc will issue over 450 billion euros in bonds by 2030, creating a true rival to Treasuries, denominated in a strengthening euro. As the EU matures its bond market, credit rating agencies like S&P and Fitch now list EU-backed bonds as AA+, just one notch below U.S. Treasuries. That's close enough for most central banks. Even Japan, which has traditionally been the stabilizing force in U.S. bond markets, is repatriating capital. With the yen falling below 160 per dollar, the Bank of Japan has started selling foreign assets to stabilize its currency. While Japan added $3.7 billion in treasuries in April, it's now under pressure to unwind. So, while official numbers show resilience, underlying flows tell a more fragile story. The Reserve Bank of India, for instance, now allows central banks to invest in sovereign green bonds issued in rupees. In June, Abu Dhabi's sovereign wealth fund became the first to diversify its reserve tranche with Indian sovereign paper. The dollar wasn't removed, it was simply bypassed. What does that mean? It means the reserve system isn't being overturned. It's being outgrown. This isn't the end of dollar dominance. It's the beginning of dollar irrelevance. For certain transactions, for certain governments, in certain moments. The erosion is conditional, not total, but erosion compounds. And with every yield spike triggered by geopolitical friction, central banks are reminded. Holding U.S. Treasuries now means holding U.S. political risk. That may be acceptable for allies. For everyone else, the alternatives have matured. If Canada, once the fifth largest U.S. creditor, can step back without warning, what stops others from following? If China can slowly replace treasuries with gold and euros without consequence, what's the incentive to stop? And if Washington continues raising tariffs without regard for financial repercussions, who pays the price? The data says the U.S. government does. The taxpayer does. And ironically, the Federal Reserve does. Through its role as the buyer of last resort when foreign appetite thins. This is the feedback loop that now defines the global bond market. Tariffs raise yields. Higher yields raise deficits. Deficits raise issuance. Issuance demands buyers. But the buyers are leaving. And still, U.S. policymakers act as though the market has no memory. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.